Hi everyone, it's Robert Weinberg, your mortgage expert and financial coach. And in this video, I want to talk about some different refinancing strategies for your property. Now, it used to be the old rule of thumb. The only reason you'd refinance is if you could lower your interest rate 1 to 2%. I can tell you now, with home values going up and mortgage balances going up, that rule of thumb unfortunately doesn't make sense anymore. There are certain circumstances where it can make sense to refinance with as little as an eighth or even 1/4% difference in your interest rate. In addition to that, a common reason that people would refinance from a strategic standpoint is to lower or shorten the term of the loan that they have. For example, if you have a 30-year mortgage with 28 years left, you've been in your home for 2 years, you may have an option to go to a 20-year or a 15-year mortgage, and that would shorten the amount of the term of the loan as well as the amount of interest that you would pay over the entire time that you're paying that loan off. The third reason and strategy behind refinancing would be to eliminate PMI. For many, especially first-time home buyers that put less than 20% down when they finance their home, there's a common mortgage insurance, or PMI as it's called, that would be attached to your loan and included in your monthly payment. Now, once you've built some equity up in your home, there are some reasons that you'd want to refinance and get out of that PMI. The number one reason is to lower your payment. So in many cases, you could actually lower your payment by anywhere from $75 to $200 or even $300 a month, depending on the balance of your mortgage, by eliminating that PMI and refinancing into a loan that does not require that. Now, one of the most common reasons that people refinance today, and one of the most strategic ways to use your mortgage as a financial tool, is for a cash-out loan. Now, what a cash-out loan is when you refinance your mortgage for more than you currently owe and pocket the difference in cash. The most common reasons that you would do this type of refinance strategy is in order to finance home improvements, like an addition or some sort of improvement on your property. The second reason is for debt consolidation. So a lot of the time you may have unsecured debt outside of your mortgage, for example, credit card debts, charge cards, student loans. And it can make sense to finance those into your mortgage because it can lower your overall monthly payments and save you a ton of interest over the term of the loan in many cases. And the last and most common reason for cash out refinance would be for business opportunities. So you may have an opportunity to start a new business or expand your current one. You may have an investment opportunity that can provide you from some good returns, or you may have a real estate opportunity that requires some sort of cash down payment and or buy in cash with no mortgage, and you would need to secure some sort of finance for that, and it makes sense to use the built-up equity in your home that's not earning you anything in order to take care of those needs. Now, from a return standpoint, the rule of thumb would typically be if you can get a mortgage, for example, at a 4.5% interest rate, and you're going to be able to invest in an opportunity that's going to pay you more than 4.5%, then in those cases you would be able to use your mortgage as a financial tool to leverage. So the example is borrow money and refinance at a 4.5% interest rate, pull out some equity, and invest that into an opportunity that may return you 6, 7, 8% interest. You pocket the difference. That's the way that a consumer can make money, the same way that the banks do. And the last thing that I want to discuss in this video is an annual review. It's very important, especially once you've been in your home for at least a few years and you've got some equity built, that you do an annual review of your mortgage and finances, and you can typically do that with your mortgage advisor. So the way that works is, as a mortgage advisor myself, I review my clients' credit reports, I review their equity scenario, and I review their financial goals and see what difference the mortgage can make in achieving those goals. Sometimes it's repositioning debt, sometimes it's eliminating PMI or shortening the term of their loan, and other times it's all of the above. So there may be opportunities for you to be able to refinance and save money. If this is of interest, and I hope it's been of value, you can always feel free to reach out to my office. Either send me a message on social media directly or text or call my office. The direct line is 860-413-3938. Take care.